Hi everybody, welcome to another video of What's Moving the Markets. Today we're going to talk about the collapse of the equity risk premium, why that's important, when was the last time this happened, and what does it mean for the markets. Then we're going to look at what's happening, tie that in with the equity risk premium collapse. So one of the things we'll be talking about is gold. And then, of course, we will be talking about AI and NVDA and how all of this fits together. So, first of all, what is the equity risk premium? What that means simply is if you're investing in the stock market, you should be making a return higher than if you just invest in government bonds, because the stock market has a higher level of risk. Government bonds are safer, right? So therefore, if you're taking a higher risk, you should be making a higher return. But that is not the case right now. So the last time this happened was when just the dot-com bubble was about to burst, and it's happened now. And why does it happen? So when you talk about return on equity, return has two moving parts, right? I mean, you'll have your earning in the numerator and you'll have the price in the denominator. So as prices go up, as the stock's prices go up, this overall value, that is the return in percentage terms, comes down, right? And because the stock market is at such a high valuation right now, the return it offers for its current earnings yield is the same as a 10-year treasury. So why would I want to invest in the stock market when I can get the same level of yield from investing in something as safe as a government bond? Which obviously then diminishes the reward for holding equities. So what does this mean for the market? Obviously, it means that investors might want to sell stocks, move into bonds, right? And then what would that mean for stock prices? So the last time this happened was 2000s, and we know that it was the dot-com bubble burst, which obviously led to a big crash in the stock market. But is the current AI rally the same as the dot-com bubble? I personally don't think so. I feel that after electricity, the AI that we are getting now is probably the biggest boost that we're going to get to productivity, right? So it's that big a thing. I mean, in terms of the first industrial revolution, second, third, and then now fourth, we really are having a revolutionary development because of the AI. It's not the same as the dot-com bubble, right? This really has legs, but you should wait to see the result of NVDA. Everybody is waiting. The whole market is waiting for this. Not just the result, but also what they say about what they're expecting in the future, because they have the best seat in the stadium, right? I mean, in the sense, me and you might not be able to see what the CEO of NVDA is seeing right now, because they are talking to their customers. They know what's happening on the ground, what's the value their customers are being able to derive out of their chips, and so on and so forth. So yes, there is pressure on the market. Equity valuations are very high. Bonds are looking more attractive right now, but I wouldn't give up on the AI rally just yet. So Wednesday, I believe, is the result of NVIDIA. Maybe you should sit on the sidelines until then. Maybe take your gains, and this is something I've been telling you for a long time, to take your gains and come out, right? Wait for the result, and then you can re-enter if the results are good, and then the guidance is good as well. So while I don't want you to fight AI, which means if the result is good, the guidance is good, you can continue to ride this train. However, if the result is not good, then already the market is very, very expensive. There is not much room for upside. And what's happened is and this is something we discussed in the last week's video, that Trump and tariffs, higher inflation, the Federal Reserve is probably not going to reduce interest rates in a big way going forward, maybe even no reductions at all, very, very small reductions. So we're definitely looking at higher interest rates, which means higher discount rates, which are bad for growth sectors, right? Because their earnings are so much into the future that higher the discount rate, the less the present value of those earnings. So who is well placed? Well, banks and utilities. Utilities, obviously, for two reasons. Number one, they're benefiting from the increased electricity demand due to the data centers. We've talked about that many times. But also there is some Trump-oriented benefit that could come into utilities because of deregulation and antitrust, as well as banks. And we talked about banks in detail in last week's video, that their capital requirement may be reduced, which means they might do a lot of share buybacks, which again could push the share price up. Citi, for instance, is probably the biggest beneficiary in this. And they benefit from the higher interest rate as well, right? They continue to benefit from the higher interest rate. So utilities and financials are definitely very well placed in all of this. And gold. So my personal favorite is gold. This is something we've been talking about for months now, and it continues to be strong. So what happened was, immediately after the election, the knee-jerk reaction of the market was they pushed the dollar up, they pushed gold down, but they could not hold that pressure. So even though Trump has won and we are looking at a stronger US dollar, but the bigger picture is just too big, and the Trump trade is not strong enough, right? So I mean, you've got central banks purchasing gold, and they're just getting started. I mean, we haven't even scratched the surface where central banks, big central banks like China, India, Russia, are de-dollarizing, right? They are selling their dollar reserves, replacing them with gold, and they've just gotten started. China especially has literally just gotten started. So a lot of room there. Plus the Trump trade also means higher geopolitical tensions, which again increases the demand for gold. So big picture view, gold is probably going to stay high, right? And maybe go up even more, which is good for gold mining companies. So in addition to banks, utilities, and overall defensive sectors, I would say definitely keep your positioning in gold. And keep a lookout on AI, right? I'm not saying completely get out of tech. Keep, especially NVDA results. So on Wednesday, you'll see those. So don't fight it. If it's good, you can definitely keep riding that train. But on the safer end, you should be considering defensive and sectors like banks if that's something that makes sense for you. I personally think gold is probably the best bet here. As the de-dollarization is there partially, and of course inflation is on the cards, even though before all of this Trump election stuff, when the Fed had started decreasing the interest rates, they were quite relaxed with the inflation outlook. They said inflation is completely under control. We are actually more worried about the labor market, and that's why they cut in such a big way, and we were thinking that they would continue to at least do 25 basis points, but now they are really worried about inflation, and rightly so, because if tariffs do come in, then that means higher prices, which we discussed in last week's video in detail, which again supports your gold demand because of inflation, because it is a hedge. So what are the key takeaways here? Key takeaway is that number one, equity risk premium is 0, which means it doesn't make sense for any investor to be in equity, take the higher risk, and earn the same thing that they would in just buying a government bond. It just doesn't make sense, right? So unless the AI boom comes in, and NVIDIA results and forward guidance is so great that the earnings growth, so earnings in the numerator, prices in the denominator, and prices have gone up. That's why obviously this entire return has come down. But if the earnings start going up even more, which could be possible. I'm not saying it's not possible, but I need to see it happen. Or at least I need to see somebody like the CEO of NVDA say that they see it's happening, right? Because they have a better view than we do. So if that is the case, then okay, that means the return I can earn from equities will be more than the yields on treasuries, because the growth in equities is going to be amazing because of this productivity enhancement due to AI. And if that is the case, very good. But if not, then I'd rather be positioned in defensive sectors. I'd rather be having a lot of exposure to gold. And if you like fixed income, then high yield bonds, government bonds could be a thing. Plus, I mean, if you can really do active management, you could identify undervalued stocks, right? So that's not everybody's cup of tea, because security selection is harder and easier said than done. So if you can do security selection, then find undervalued stocks in good sectors like healthcare and energy. But it's not easy to do, because you really have to evaluate the impact of Trump's policies on the energy sector. It's not going to be the same for all types of companies. And the same goes for healthcare, especially if Trump's new nominee, Kennedy Jr., is appointed Secretary of Health. Now, he still needs confirmation from the House, but if that does happen, even though it might not happen because it's going to be difficult, he has very, very controversial views on many companies in the healthcare industry. So, but if he does get confirmed, then the impact on healthcare is going to be mixed. So you really need to find which sectors, subsectors will benefit and which companies will benefit. And maybe in next week's video, I might do an analysis in detail of healthcare and energy sector, subsector wise, industry wise, and company wise, maybe to help you guys position in that. Plus, in the comment section, I've been seeing that there are people who, one of the comments I saw was that if I can also do an analysis of other markets, not just the US, so maybe some Middle Eastern markets, Indian market, Asian markets, and I would love to do that. It's just that I've been so busy, but I will, and I want to definitely start taking more time out, and in these videos not only talk about the US market, but also touch upon the implications of global developments for Middle Eastern markets, for Asian markets as well. So hopefully I will get around to start doing that soon as well. But for this video, obviously, what I want you to do is be ready for any correction in the US market, position defensively, like I have been saying. Gold is your friend as geopolitical risks re-emerge and inflation is high. So keep exposure to gold. As always, if you found it useful, please like, share, and subscribe. And your comments are most welcome. It really helps me stay in touch with you. And I just love to be able to do this for you, right? So I'm here. Whatever you want, whatever you need in terms of analysis of stock markets globally, please share in the comments and I'll try to incorporate that in the analysis. Thank you and see you next week.